Holy cow, Fastly shares are up 30% today. I'm going to talk about why shares are up and whether or not I think it might make sense to look into owning Fastly as a stock right now. So let's get to it. All right, we're going to read through this article and then I'm going to run through my current portfolio as well as some different valuation estimates on Fastly and some comparison to other companies, right? Every time we own a stock, we are choosing not to own other companies with that money. So Fastly shares show no signs of cooling down Monday and remained up by 30% after Bank of America securities analyst Tal Liani, maybe get that name wrong, upgraded the cloud services tech company due to a handful of factors such as the efforts of its new management team. They lifted Fastly all the way from underperform or sell up to buy and boosted his price target on the company's stock to $16 a share from $10.50. So you're talking about a 50% plus increase in the value of this company, according to what they said. They said that while Fastly's short-term results could still fluctuate, company has solid underlying foundations, and new chief executive Todd Nightingale, that's a pretty sweet last name, has taken steps to streamline its product portfolio, pricing, and other business aspects. He joined Fastly in September of 2022 from Cisco Systems and has instituted a company-wide turnaround strategy that includes more focus on core strengths and moving into network security. Before we go any further with Fastly, I want to share my portfolio. I do it all the time on this channel. Just look back at the other videos. $149,580. This is all time, so since February 15th, 2022, we are up $13,437, which is showing as up 16.515%. You might notice that's not 16.15% of 149,000. It has to do with when the money came into the account that it's getting this return off of. Either way, we're up $13,437. Here's the largest positions. You can take a screenshot. You can do whatever you want. This isn't to copy me. This is just to share my portfolio transparently. I do share all of my investments, all of my decisions, and more research in my email newsletter, austin.substack.com, which is linked below. Okay, I do not own Fastly, but I own some companies in like the cloud and software as a service and tech space, specifically Snowflake and Datadog, that I would say I would rather own than Fastly. That is basically the choice I'm making by owning these two companies instead of Fastly. So let's talk about that. Jumping over quickly to Morningstar, they've got a 4-star rating on Fastly, which just comes down to if they think it's overvalued or undervalued. And they actually say it's trading at a 51% discount to fair value. But that valuation is from August 4th, 2022. They have not updated it since then, right? But this was updated in November. It talks about the fair value and the profit drivers of the business, right? We are maintaining our $20 fair value estimate for Fastly. Our valuation implies a terminal EBITDA multiple of 12 times. Our 2031 adjusted EBITDA projection of $970 million, which is a 40% margin. So how are they forecasting out to 2031? That's kind of insane. We project Fastly will maintain fast revenue growth throughout our 10-year forecast, averaging more than 20% annually, although we expect the growth rate of spending from existing customers to slow from 2021 levels. We project the firm's net retention rate, which essentially represents same customer sales from the base of customers existing in the prior period, including lost revenue from customers who have left, to remain around 115%. However, we also expect Fastly to continue gaining new customers, with new customer revenue driven predominantly by enterprise customers. Okay, so that's basically their forecast. They're forecasting out to 2031 to get that fair value estimate. Now, this is a pretty simple decision for me, right? Like, Fastly's a turnaround story. And so if I'm going to invest in Fastly, it means I have to believe in that turnaround story and that I'm going to put money towards Fastly instead of something like Datadog, Snowflake, Google, or Meta. So that's what I'm comparing it to. And something I want to do a better job of in these videos is showing kind of like perspective, right? Like, where have things been and where are they today? And right now we're looking at price to sales multiples, right? And this is showing Fastly, Akamai, Datadog, Snowflake, Google, and Meta. Back in 2018, the only three that were public are Meta, Google, and Akamai. And what we can see is back in 2018, Meta traded at a price sales ratio of 12.66, Google at 6.85, and Akamai at 4.5, right? And those came down a little bit over time. For Meta in 2019 was at 8.8, Google at 5.6, Akamai at 5.2, and Fastly now public at 3.88. All right, now we're at December of 2019, right before the pandemic. I think that's when it happened, right? Everything's blurring together. Datadog's now public, price sales of 14.5. Meta's at 8.2, Fastly's at 6.8. Google's at 5.7 and Akamai's at 4.8, right? Okay, let's see where things got so crazy and why these stocks have had such a hard couple of years. October of 2020, Datadog at a price sales ratio of 64. Fastly at 47, Snowflake at 32, Meta at 9, Google at 6, Akamai at 6. Okay, now fast forward to November 2021. Snowflake at 114, Datadog at 66, Fastly at 16, Meta at 8.6, Google at 8.3, Akamai at 5.2. And then to today, we could see the numbers up here. Fastly at 2.8, Akamai at 3.8, Datadog at 16.5, Snowflake at 26, Google at 4.3, and Meta at 4.1, right? So things have come down a lot, and we can see why these stocks are just like down so much over the past 2 years, basically. They just got way too expensive, right? That doesn't mean they're all bad companies. You can see over the last year, Fastly down 65%, Akamai down 24%, Datadog down 53%, Snowflake down 49%, Google down 31%, Meta down 23% still over the last year. But if we can zoom out, the ones we can zoom out on, we're actually doing decent over the last 5 and 10 years, right? So 10 years, Akamai's up 141%. Google's up 380%. Meta's up 510%. So a little perspective, we're still doing okay on our investments, in some of these good long-term companies, even though the last year has been so rough, right? Okay, now, owning Fastly right here, right now, do I want to? And it's pretty simple. I mean, just based on what analysts are expecting, and I have not studied the company deeply lately, I am not at all interested in owning Fastly because revenue growth is slowing down. You could see 21% revenue growth year over year, looking at 19% forward. Or I could own something like Datadog or Snowflake, 74 and 81% year-over-year revenue growth, 53% forward revenue growth for Datadog, 72% for Snowflake, and then even 9% for Google, which is sure it's lower than Fastly's forward 19%. But let's look at the price to earnings expectations right now. Fastly still expected a price to earnings ratio of negative 37 3 years from now because they're not expected to be profitable. Whereas Datadog is sure they have a high PE ratio, but it's coming down every year because they're growing that revenue pretty quick and earnings pretty quick. And if they can keep it up, the PE will come into a decent range, right? They've got a positive PE at least of 52, Snowflake 165, and Google down to 13 and Meta at 13 3 years from now, based on expectations. So I simply can't justify an unproven company in terms of profitability like Fastly that is struggling with revenue growth. It's not in hyper revenue growth like Datadog and Snowflake. That can make up for, some unprofitability because you can get there eventually if revenue is going to grow fast enough. I just can't justify it owning a company like Fastly right now. And sure, I might be wrong on the investment. It could turn out to be an amazing return in a great company, but it's just not the kind of company that I can justify owning right now versus my other options when we think about the risk and reward, right? And even from a profitability perspective, the gross profit margin is 47% for Fastly, 79% for Datadog, 65% for Snowflake, 55% for Google, and 79% for Meta. And then we've seen a lot of focus on hiring, right? Where companies are laying off employees. It's because they just need to focus on cash flow and becoming more profitable. Well, Fastly's net income per employee was minus $206,000, where Datadog is minus $4,000, Snowflake's minus $130,000, but remember these two are growing a lot faster and going after larger markets. Google's at $315,000 of net income per employee, and Meta's at $268,000 of net income per employee. And so the bottom line is I just cannot justify owning Fastly right now, even though it's up 30% today, and these analysts have 50 to 100% upside in the stock right now based off their price estimates. I just couldn't put enough money in the company and then justify selling something else right now to warrant or get comfortable owning shares. And that's just my take on this, right? So thanks for watching. If you've made it this far, do me a favor, like the video, subscribe, drop a comment, let me know your thoughts, and then check my newsletter out, austin.substack.com, linked in the description below. Have a great day.